Dean of Business and Economics.
Chancellor. Emeritus Professor Robert Officer has given years of distinguished service to the Australian community. He is an outstanding example of positive action that flows from a deep academic understanding. Professor Officer began his professional journey as an agricultural science student at the University of Melbourne. Graduating with a PhD from the University of Chicago in 1971, where his doctoral thesis was supervised by Professor Eugene Farmer, later a Nobel laureate in economics, Professor Officer was at the forefront of the then rapidly developing application of economic principles to financial markets and decisions. Returning to Australia soon after graduation, he was one of an elite group who brought the systematic study of finance into mainstream teaching and research in Australia's universities. Professor Officer is very well known to and highly regarded by the Australian business community. On 2 occasions, he was appointed by newly elected governments to conduct a wide-ranging policy review, and other contributions have included 10 years as a director of the Victorian Transport Accident Commission, 10 years as a director of the Victorian Funds Management Corporation, and 3 years as chairman of the Victorian Work Cover Authority. One of Professor Officer's most notable and lasting contributions has been the reform of Australia's taxation system. His analysis and advocacy of the imputation system of dividend taxation played an important role in its adoption in Australia in the late 1980s. This system has affected the decision-making of untold thousands of Australian companies and millions of shareholders. Professor Officer's contributions extend also to the not-for-profit sector, where a number of foundations and associations have benefited from his expertise. Chancellor, I present to you Professor Robert Officer for admission to the degree of Doctor of Commerce, honoris causa.
Congratulations. Professor Robert Officer will now deliver the occasional address.
Thank you, Chancellor. The last time I had the honour of giving an occasional address to graduates about 10 years ago, I talked about the need for resilience in the face of career adversities. This time I intend to talk about taxes, which are just as ubiquitous as career adversities. There's a saying in the tax literature that an old tax is a good tax. Why? Because new taxes can have unintended consequences. They can also impose significant deadweight costs, such as new administrative and compliance complexities. When introducing a new tax, the government needs to be sure that these costs do not outweigh their benefits. It's a rare election campaign where taxes are not an issue. The recent federal election was no exception. And the return of the government will not necessarily save us from further changes to the tax system, beyond the promised tax relief. Governments, and indeed economists, lawyers and accountants, are always looking for the optimal tax system, whereas in fact, as you all know, the optimal system is the one the other person's paying. Every tax has a base, the thing on which the tax is levied. The base may be of the value of something consumed, a consumption tax, or the value of something saved, an investment tax. An income tax is effectively a tax on both consumption and saving or investment. There are those who would argue we should put greater emphasis on consumption tax, because such taxes favour investment and production over consumption. Well, this is true enough, but what is the purpose of production if it isn't for consumption? Hence, the relative merits of investment or savings taxes over consumption taxes is really a personal thing. It depends on your preference for current consumption over future consumption. Some people argue, consistent with a comprehensive income tax, that capital gains should be taxed at the same rate of income. But this ignores the nature of our tax system, which includes both investment and consumption taxes. Allowing a discount for capital gains puts less weight on investment tax and hence more weight on consumption. Whether we want a higher or lower weight on investment taxes depends on the objective. We do know whichever mix of investment or consumption tax is chosen, it will affect resource allocation. And during the recent election, this really wasn't addressed, even though there was a decrease in consumption or increase in capital gains tax. Similarly, there have been calls for a reduction in company taxation on the grounds that Australian company taxes are amongst the highest in the world. But this ignores the fact that Australia has an imputation company tax system, and in contrast to the statutory rate, which for most companies is 30%, the actual Australian company tax rate, when we include franking credits, is nearer 20%. This compares with world company tax averages of about 26% or 24% for OECD countries. Those who argue for a reduction in Australian company taxes are really arguing Australia needs to attract more foreign capital because foreigners do not get the benefit from the imputation tax system. The domestic demand for and supply of foreign capital depends on its price. Taxes certainly influence that price, but ultimately the price of foreign capital is the exchange rate. If Australia needs more foreign capital, then the exchange rate will drop. It will have to pay a higher price for that capital. So it's the exchange rate that is important to this, not the tax system. The examples I've given reinforce the aphorism that an old tax is a good tax. It is a saying that should be remembered by policymakers before they reach for the tax weapon to raise or lower revenue.